So that should be lecture 7. I'll correct it on the web. So this lecture is all about the Markowitz problem and various manipulations of the Markowitz problem, and to understand how this problem has something to say about market equilibrium, prices of assets in the market, and so on. So let me just start with this problem that we have already stated before and just put some more definitions in. So what we're going to do is we're going to consider a market with capital N assets. And N will be assumed to be greater than or equal to 2. There are at least 2 assets in the market. They are characterized by a mean vector mu, which is in R capital N, and a covariance matrix sigma, which is in R n times n, and also I'm assuming that sigma is positive definite. It's not just positive semi-definite, it's in fact positive definite. Which means basically the returns of, okay, something stronger is meant than what I'm just about to say. If sigma is positive definite, it definitely means that all the assets in the market are risky, meaning that the returns are going to have some random component. So the returns of all assets has a random component. And that is what we will call a risky asset. So this is equivalent to saying all assets are risky. Later on, about halfway through the lecture, we'll introduce a riskless asset, which does not have risk. But here we're going to start off this lecture by assuming that all assets have a certain amount of risk. That's another typo which has to be corrected. This should have been a phi instead of a pi. And then we're going to talk about portfolios. So for today's lecture, a portfolio would mean any vector phi, which is in Rn, which means has n components and sums to 1. Phi does not have to be a non-negative vector. It's just a vector of capital N components that add up to 1. And what we'd be interested in, what we are after is the following thing. I want to construct a portfolio. So the problem that we are after is this. You want to construct a portfolio that has minimum return, or minimum variance for expected return equal to some number alpha. Alpha is a variable. I want to construct a family of portfolios. As I change alpha, the portfolio will change. So I'm going to label this portfolio by phi star alpha, or phi sub alpha. Phi sub alpha is a portfolio, meaning it's a vector of capital N components which add up to 1, such that this portfolio has the minimum variance among all those portfolios with expected return equal to alpha. So phi alpha is a solution of this quadratic program. This constraint simply says that the vectors phi must add up to 1, the components of phi must add up to 1. This constraint here says that the expected return on the portfolio phi is exactly equal to alpha. The half is there just for convenience. So you're minimizing the variance subject to the constraint that the expected return is exactly equal to alpha. The optimum solution, any optimal solution of this quadratic program will be called phi alpha. And what we really, so for now I'm not telling you why I call it a frontier, but what I finally want to do is that for every alpha, I want to find out the minimum achievable variance sigma squared alpha. So alpha is the expected return on the portfolio. Sigma squared alpha is the minimum variance that can be achieved for that expected return. So let's say that curve looks something like this. Here is sigma squared alpha. On the x-axis I'm plotting sigma squared alpha. On the y-axis I have alpha. So things are a little bit twisted. But this is the convention by which people plot these curves. So let's stick with the convention. So maybe that curve looks something like this, let's say. I don't know, something like that. Sigma squared alpha is going to be always a non-negative quantity. It's a variance. It could be 0, but the way I have plotted it, it's not 0. For every given value of alpha, let's say alpha 1, there is a corresponding minimum return, minimum variance here, sigma squared alpha 1. Here's alpha 2. There's a corresponding minimum quantity here, sigma squared of alpha 2. And what I really want to do is find out what that curve looks like. What is that entire curve? I want to calculate this curve. So if I take something in here, suppose I create a portfolio which has that value. It has whatever here's the expected return, it's a bad drawing. Suppose this is alpha and sigma squared, and here's what is sigma squared. So I create a portfolio phi which has mu transpose phi equal to alpha, and phi transpose sigma phi, which is a variance, is equal to sigma squared, where these are the numbers on this curve. Would you like to hold this portfolio?
No.
No. Why? Yes, for the same expected return, this point here is going to give you the minimum variance. It gives you this point here on this curve. This point is strictly better than that point because it has the same expected return but much less variance. So anything inside this set here is something which is inefficient. You can find something better by going to the frontier. So this frontier is the place that you'll want to be. So the line here, the minimum achievable variance for any given return, is the frontier on which you always want to be. When you move to the right hand side, you give up on variance. Why can't you be over here? It's infeasible. That is not something that is achievable in the market. This is the best achievable thing that's in the market. Any point that lies on this frontier, if a portfolio creates a value alpha and sigma squared such that it lies on that frontier, we'll call it a frontier portfolio. That's what this frontier stands for. It's coming from that curve that we are after on the alpha, sigma squared alpha plane. All right?
Is it possible that you can have a curve look like that, but you have lower alpha, you have a higher risk?
Yes, you could. The reason is this, because I'm going to insist that it's exactly equal to alpha. If I make this inequality, then what you're saying will not happen. And we will see that you would never want to hold anything down here. It doesn't make any sense. If you're holding something here, you might as well hold something there. But because I'm constructing this curve by insisting that the return be exactly equal to alpha, you'll get this curve. Later on, you will argue, one can argue that, well, if you're interested in alpha and I give you something better than alpha, you would never want to go down this curve. So you would stop here. Anything below this curve is useless for you. I can give you a better point than that. All right? That's just a artifact of this. And the reason this is made to an equality is because equality constrained QPs are nice. I can write out solutions. I can give you the curve. I can do everything. Once I make it inequality, it becomes a nasty one. In the homework problem that you'll be given this week, you will get an inequality there. It'll become ugly. But there we are not looking for closed form solutions. I'll just ask you to plot out what the frontier looks like. In class, we are going to talk about simple closed form solution that gives more intuition. But you're absolutely right, the lower portion is useless. Question?
Is there any restrictions on the fly eyes? I can short also?
Yes, you can short. There's absolutely, again, so the question was there a constraint on the phi eyes? Again, the story is in the homework that you will get. There will be restrictions on phi eyes, and when we come to that, I'll discuss that in a moment. But having constraints on phi eye means inequality constraints. And again, I can't write things out in a nice closed form. This is sort of, think of this problem as the simplest problem that gives you some trade-off between returns and risk. And you can write things explicitly, you can compute things, it gives you very nice pictures. and then you get nice connections between what's happening here and linear regression. So that's why this problem becomes interesting. In practice, there are all kinds of site constraints, all kinds of things. So in practice, this may not be the end thing, but it gives you a starting point. Okay. All right. So here's what we're going to do. We're going to compute the optimal solution for that LP. We've done this before. You end up getting from the Lagrangian conditions that the optimum portfolio phi must satisfy, or let's just write it out, one more repetition wouldn't hurt anything. You are minimizing 1/2 of x transpose sigma x such that mu transpose x is equal to alpha and 1 transpose x is equal to 1. Lagrangian conditions for this would give me that the gradient of this guy, which is sigma x, must equal or minus the first multiplier lambda times the gradient of this constraint, which is mu, plus or minus another multiplier gamma times the constraint, the second one, which is 1, must equal 0, which gives me that x must equal lambda times sigma inverse of mu plus gamma times sigma inverse of 1. That's the first statement over there. Instead of just calling those multipliers V1 and V2, I decided to call those multipliers lambda and gamma. I take this and I plug it into the two constraints that I needed to satisfy, and I end up getting this system of equations. Lambda times mu transpose sigma inverse mu plus gamma times mu transpose sigma inverse of 1 is equal to alpha lambda times 1 transpose sigma inverse mu plus gamma times 1 transpose sigma inverse 1 is equal to 1. I just plug that into those expressions there. Let's just call this quantity, this whole quantity A, or what did I call this? B. B. So this is B, this is A, this is also A, and that's C. Just makes life a little easier. And you end up getting expressions. So in the homework you'll be asked to do this, and it's better to just write out something. It makes life a little simpler. Okay, so when you solve this, you end up getting, and how do you solve this? Use Cramer's rule that lambda is equal to C alpha minus A divided by D, and mu is equal to B minus A alpha divided by D, where D is equal to BC minus A squared. So all you're taking is determinant of some matrix divided by the determinant of the constraint matrix that you've got. Use Cramer's rule, you end up getting that constraint. Okay. So you get the value of lambda and mu, and then you plug it back into this expression, rearrange a few things, and you end up getting that x must look like the following. It's some portfolio G plus alpha times a portfolio H. All I'm doing is I'm plugging in this value of lambda and mu into this expression, collecting together all the terms that correspond to alpha and calling them H, collecting together all the constant terms and calling that G. All right, it's just pure algebra. Here's the expression for what H and G looks like. All right. The thing that's, to me, that the thing that's important here is what you're saying is if a particular, so let me, instead of x, let me put phi of alpha. So what this expression says is that the frontier portfolio always has linear dependence on alpha. You tell me an alpha, and if you're interested in the frontier portfolio corresponding to that return alpha, it always has this structure. G is a constant, it doesn't depend on alpha. H is a constant, it doesn't depend on alpha. And phi of alpha has this nice structure, it's G plus alpha times H. Just these two constant vectors G and H describe the entire portfolio, entire set of frontier portfolios. Whatever happens on this frontier, wherever you are on this frontier, you can be described by looking at just two vectors, G and H. And one can do another step forward and talk about what is the meaning of this vector G. The vector G is the frontier portfolio corresponding to alpha equal to 0. So G has a meaning. G is the optimum or frontier for alpha equal to 0. And the vector G plus H is the optimum or the frontier for alpha equal to 1. And you can pretend as if the entire portfolio, not pretend, it is indeed the case that the entire frontier here can be generated by just looking at the vector G and H, or equivalently by looking at the vectors G plus H and G. So this is what this little theorem here says, that the entire frontier set is described by G plus alpha times H, where alpha is in the real line, or you can write it this way. It's a convex combination of two different portfolios. The portfolio G, which gives you a return of 0, and the portfolio G plus H, which gives you a return of 1. And it's a combination of these two. 1 minus alpha weight put on the portfolio G, and alpha weight put on the portfolio G plus H. Yeah?
Can you elaborate on the financial implications of this contract?
One thing, this is in the financial setting, this means that this market has something called two-fund separation. What it means is that if you are an investor, as an investor, if you're only interested in these two quantities, the risk that is described by the variance and the return which is given by the expected returns. You're only interested in these two quantities. You want to go down on the risk and go up on the expected return. Then anybody can be satisfied by just holding these two mutual funds. G is a mutual fund. What's a mutual fund? It's just a position in the various assets. G is a portfolio, therefore it's a position on the various assets. G plus H is a portfolio, and therefore it's a position on the various assets. And what this statement here is saying is that if everybody in the market was interested in an optimization problem of this kind, then they will all be satisfied by just having these two mutual funds in the market, G and G plus H. You don't care about any of the other assets. Yes?
This problem seems a little bit different from the one we have in the morning. The mu is not known yet, right? So
no, everything is known. If this is not known.
mu is a known.
Yes, mu is known, sigma is known.
You solve for mu equal to B minus A alpha over D.
Oh, okay. Sorry, this is gamma.
Oh,
Mu is known.
okay.
Question? Now, in the homework, what we will show, what you will be asked to show is that, in fact, something even more general is true. The entire portfolio can be generated by looking at just two mutual funds, any old two mutual funds that lie on the portfolio frontier with different returns. Here, I've taken the special case of one portfolio that has a return of 1 and another portfolio that has a return of 0. And I'm telling you here that the entire frontier can be generated by these two mutual funds, but 0 and 1 are nothing special. If I give you one mutual fund which has a return alpha 1 and another mutual fund with return alpha 2, where alpha 1 is not equal to alpha 2, then the entire frontier can be generated by looking at these two mutual funds. Again, the same kind of, a little bit of algebraic technique, but you'll end up getting the same result. All right? Question? Because of this picture. This is the frontier on which you want to be. This side is infeasible, that side is inefficient. So this frontier is the efficient frontier. It's the place you want to be if you want a particular return. If you want this return, you want to be right here. You don't want to be inside, and you can't be on this side. You cannot be on this side because that's infeasible. You cannot achieve it. This is achievable, but you don't want to be there because you're wasting money. So you want to be right at this frontier, which happens to be efficient. Okay?
So it seems that this position will force the shape of this curve to become cave over time.
In fact, something stronger, not just concave. Because if something, what will happen is that this will be linear. Up there you're sitting at a quadratic. So in fact, it's much stronger. It'll become a parabola. Not just concave, you can say something even more. But your statement is true if you put trading restrictions, meaning that you had to hold only x non-negative. Then you will have to worry about whether this becomes, depends, this will become a convex set. It's better to think in terms of the feasible points to be in a convex set rather than to think in terms of a concave curve. It will always be a feasible convex set, but the shape can change depending upon what restrictions you put on trading. All right, so that's this last part here is what I've shown here, generated by two frontier portfolios, G and G plus H, and in the homework you will show that it's generated by any two frontier portfolios, as long as their returns are different. Okay, so this is the next part. So now what do I have? What I have so far is this story, that if I'm trying to solve that linear program, the optimum portfolio phi of alpha has this structure. It's a constant G plus alpha times H. G and H are numbers that do not depend on alpha. They are fixed constants. And now what I want to look at is what happens to sigma squared of alpha. And what is sigma squared of alpha? It's just phi of alpha transpose sigma phi of alpha. It's the variance achieved at the minimum variance portfolio. Okay, I fix alpha, I solve this linear program or this quadratic program, I end up getting that phi of alpha should look like that. Here I'm just simply computing what the variance of that minimum variance portfolio looks like, and that has that form. This quantity is C over D times alpha minus A over C plus 1 over C. That's what the curve, and squared over here. This is how this curve looks like. If you plot it on a curve where the x-axis is alpha and the y-axis is sigma squared. So the x-axis is the return alpha and the y-axis is sigma squared. So this is the quantity that I'm putting on, this is what I'm going to put on the x-axis, and this is what is going to sit on the y-axis. Why is it tilted over? I don't know. This is the convention that this field adopts. So this is going to be plotted on the x-axis. Okay, and what does this curve look like? What is its minimum value?
It's 1 over C.
Minimum value is 1 over C. Here. I always get confused. Okay. Minimum value is 1 over C, and at what return is it achieved? At what value of alpha is it achieved? A over C. So here's A over C. So this is the minimum point. And what does this curve look like? It's a parabola. So this curve would look like this. Okay. So that's the efficient frontier when there is no trading restrictions. Right? And you can put in the slides that went by, there was an algebraic definition what was C was, what D was, A and C, and you can all compute everything. And this is what I did. I just computed A, C, and D and put it into MATLAB to plot this thing. And you'll be asked to do the same thing in the homework. Rather than using MATLAB, you'll have to do it in Excel, and I don't know how to do it in Excel. So it's easier for me to do it in MATLAB.
Can we do it in MATLAB?
Sure. I don't have any problem. As long as somebody doesn't come asking me how to do it in Excel, I have absolutely no problem. But I'm sure it should be possible. Plotting should be possible in Excel. All right. Few things before so this is sort of the first fundamental result when you talk about Markovitch portfolio selection is this thing. So if you're going to be financial engineers, you should at some point have seen this, and the idea of showing you this in this course is so that early on you understand when you've got a market which is described by just the expected return and the variance covariance matrix, the efficient portfolios look like a parabola. You can easily compute what this parabola looks like by just looking at mu and sigma. Because these constants C, D, and A just depend on mu and sigma, you can compute it, you can plot out this entire thing. Okay, now going back to this question that was asked before, would you ever be interested in this point? No. Why not? Yeah? Exactly. For the same variance or the same risk, you can go here and get a better expected return. So although this plot turns out is given as the whole thing here, only this top half, I should probably put a different color there, this half is the one that's truly efficient. The bottom half is efficient in a sort of a mathematical sense, that if you insist on getting this return, then that's the variance you get. But in the market, if that variance gives you a better return, you'll go up there. So this curve down here is mathematically efficient, but that's the one that's truly efficient in an economic sense. Question?
Shouldn't we have taken into account the correlation between the shares, the stocks? I mean, if the correlation is +1, then Google will have a straight line, and as it goes to -1, then...
Good. In the homework, you will do it. So here what I've done is that, in general, this is what it will look like. As long, and this thing can get degenerate and get to just a straight line, and tilt it over and get a straight line, and so on. You will do a problem with just two assets, with just one covariance, that will give you the picture of everything here. Okay. All right. Before we leave this topic and go to more general stuff, let's ask ourselves the following question. Suppose instead of having x unrestricted, I had x greater than or equal to 0. Okay. Let's say we had this extra constraint that you could only hold long positions. What do you think would happen to the efficient frontier? In general, which direction would it move in? For a given alpha, so if I want to get a particular expected return, what is likely to happen to the risk? The variance would go up, because you're restricting your choices. You're trying to minimize the variance. If this wasn't there, then this was the variance that you could get. If I put some extra constraints on it, the variance can only become bigger. It can never become smaller. Yeah?
Doesn't it also reduce the feasible region? Like,
yes, it does reduce the...
It would truncate the parabola because it would be certain returns that you couldn't get.
True. But in any case, for a given alpha, that would mean that it will go off to infinity, which is certainly possible, but it will always move to the right side. So any trading restriction would move this point in this direction. So you can sort of think of this efficient frontier, the way we have drawn it, as the best possible thing that you could possibly do. More often than not, you will actually be inside there. Okay. Now the next question is, suppose, so let's draw another picture. Let's keep this picture there. Suppose this is alpha 1. I'm trying to figure out, can the portfolio efficient frontier ever look like that? That's alpha 2, there's alpha 3.
No.
Can it look like that? No, why not?
Because you can form any combination of the other two portfolio that would be better than the one that's lower.
Even if you had trading restrictions? I'm assuming that there are trading restrictions. So what would that mean in terms of, so in order for your answer to make sense, what do you want the feasible set here to be? Question? Somebody made a comment somewhere?
They should be also negative.
No.
Negative.
What?
Alpha should be able to be negative. to be able to do the whole.
No, here, no, alpha doesn't have, I'm just talking about these three things. So alpha, all three alphas are positive here. Alpha 1 is positive, alpha 2 is positive, alpha 3 is positive. So alpha doesn't have to be negative. But what kind of restrictions, what kind of things should be allowed in the trading set for you to make sure that this kind of a kink never happens? The answer that you were giving makes sense. We just want one step further than that.
You must be able to short some of that.
Not necessary. Because if you're holding just these two portfolios, you don't have to short anything to get something here. Because both alpha 1 and alpha 3 are positive, and alpha 2 is positive, you don't need any shorting. What you need is to make sure that your trading set is convex. As long as your trading set is convex, what you do is you get your portfolio corresponding to this one, phi of alpha 3, get your portfolio corresponding to this one, phi of alpha 1, and create a new portfolio phi, which is simply alpha 2 minus alpha 1 divided by alpha 3 minus alpha 1 times phi of alpha 3 plus alpha 3 or alpha 2 minus, where is it going? Alpha 3 minus alpha 2 divided by alpha 3 minus alpha 1, phi of alpha 1. This phi would give you a return which will lie on this straight line. So you can do better, and there is no reason to short. As long as your trading set here is a convex set, everything's fine. When is the trading set not convex? Under what circumstances? Naturally occurring circumstances that the trading set is not convex.
You can only buy certain lots of certain.
Yes, that's one of the reasons. Even more simple, so lot sizing causes major problems with that. Certain things are achievable, certain things are not. It doesn't look convex anymore. Another possibility is if you have fixed transaction costs, which is sort of related to lot sizing. Yeah, right. Lot sizing causes more problems than transaction costs, but qualitatively they're the same. Right? Okay, so that's just an aside. So keep in mind that this efficient portfolio is the one for no trading restrictions. If you have trading restriction, it tends to move to the right-hand side. And if what you can do with X is a convex set, then this set, the set that is achievable, is always convex. So it doesn't make sense actually to talk about this curve being convex or concave, but it does make sense to talk about the feasible set here being convex. And if the trading restrictions are convex, then the feasible set is always convex. And you can do that by this, taking a combination of this and that. And if those of you who might have done electrical engineering background, this is time sharing. You have two different strategies that you can do, and you can time share between the two to get anything in between. Okay.
So what's lot sizing?
What is lot sizing? Lot sizing means that you can buy securities only in certain sizes. For accounting reasons, people don't want to buy securities in odd sizes. Like you don't want to buy 52 shares. You would rather buy 50 or 100. That means there is non-convexity here. You're saying X can either take value 50 or it can take the value 100 or 150 and so on. And that would mean that the efficient frontier will not be convex. Okay. One interesting portfolio, which is this one, this particular portfolio has a name called the minimum variance portfolio, MVP, most valuable player. No. So this one has an important economic meaning as well as important meaning in terms of computing things, and that's the expression for it. Alpha, the return at the minimum variance portfolio is A over C, and the variance at the minimum variance portfolio is 1 over C, and that's what we got from that expression. All right? Any questions so far? Here are basically the punchlines of this story so far. This is the quadratic program you solve. This is the structure of the efficient frontier. It's basically given by 1 alpha. You take any two portfolios G and H, stick it with an alpha, you can generate the entire frontier that way. You put in this expression into the definition of the variance, and you end up getting that the frontier is given by a parabola. All right, so far that's all we've done. We can get rid of this. That's not really relevant to what we're off to. Okay. Next, what we want to do is put in a riskless asset. So typically, in the market, in addition to the risky assets, meaning assets that have random returns, there is a bank which would give you a fixed return, a fixed interest rate. And unless banks go bankrupt, you are sure to get back this fixed return. There's a little bit of an approximation here is because you don't know what inflation is going to be, so you don't know how to value that dollar. So for the moment, we are assuming that the economy either has a fixed known inflation or equally assuming that inflation is zero. If there is a random inflation, then you've got this problem of what does it mean to be riskless? I mean, it's riskless in the sense that it will give you $1 tomorrow, but I don't know the value of that dollar tomorrow. I don't know the buying power of that dollar. So here I'm assuming that inflation is absent or completely known, both of which are the same. All right, and I want to do the same thing again. I just want to figure out what does the efficient frontier look like when you have n plus 1 assets, except that the n plus 1th asset has this special property. So now let's leave it there. So this is what the efficient frontier is for only risky assets. Now we want to construct a problem where we want to find out what happens to the frontier when you have a riskless asset. So the mu of n plus 1, meaning the return, the expected return on the n plus 1th asset is exactly equal to Rf, but has no variance. It doesn't have any contribution to the matrix sigma. Its diagonal entry there is 0. It doesn't have a variance. And in our computations that we have done so far, we had to take the inverse of that sigma. In order to find out what the efficient frontier looks like, we had to invert the matrix. If I have an element 0 sitting there, I can't invert it. Therefore, in this setting, when you have a riskless asset, it's better to work in terms of a portfolio vector phi, which only represents the fraction in the risky assets. Okay? So now, when I'm talking here, phi is equal to the proportion, phi is still a vector in Rn, not n plus 1. It only has n components. It only tells you how much you're investing in the risky assets. And the position in the riskless asset is simply given by the scalar 1 minus the vector 1 transpose phi. You add up all the positions in the risky assets and subtract it from 1. That tells you how much you're holding in the riskless asset. So the total position in the market is represented by this vector phi, which no longer sums to 1, and the last component is 1 minus 1 transpose phi. So this entire vector now sums to 1. All right?
Phi is for those risky ones.
For the risky assets. Okay. Again, the frontier portfolio is defined the same way. This is what the frontier portfolio would look like. You want to minimize the variance subject to the constraint that the expected return is equal to alpha. This part is same as before, mu transpose phi. This part here tells you how much you have put into the risky assets, and the return you get on the risky assets is Rf. Right? That should be equal to alpha. I have dropped the constraint, this one, that 1 transpose x is equal to 1. This constraint has been dropped because if you add up the vector phi and this extra component, 1 minus 1 transpose phi, it always satisfies that constraint. Right? So I've dropped that. Now what you end up getting is that the optimum portfolio, there's only one constraint here. Last time there were 2 constraints, this one and that one, and you ended up getting that anybody who's investing in the market is happy if I give you 2 mutual funds. 2 different portfolios, take a combination of that, I can make you happy. This time there is only one constraint, and therefore you end up getting that in this market, people would be happy holding just one mutual fund and the riskless asset. There's a riskless asset which you can hold, which is like one mutual fund, and the other mutual fund is simply this quantity here. And you end up getting that phi star alpha here, or phi alpha, is simply given by alpha minus RF divided by, what is it, H times sigma inverse of mu minus RF1. It's the same exercise as we did before, just a bunch of things you end up calculating. Now there's an expression that I didn't write here, which I should have, which would have made my life a little simpler, which is the following. And I'll put in the algebra because it's important to see how that algebra comes to be. If you now compute sigma squared of alpha, the variance that you can generate by looking at this portfolio phi of alpha, you end up getting that sigma squared of alpha has an expression which looks like some constant, let's call it, have used A, B, some kappa, plus alpha times eta. That's what this expression looks like. So the kappa and eta are constants. And I'll put in the expression into the lecture notes after the class. Alpha is, of course, the expected return. So what it means is that the variance, rather than being a quadratic function now, in the previous case, the variance was a quadratic function. We had this expression, sigma squared of alpha is equal to C over D alpha minus A over C squared plus 1 over C. Here you'll end up getting that sigma squared is, in fact, given by a straight line. And there are some restrictions, and I'll put that in a moment when I finish with the lecture, and I'll put in the numbers. Okay, if that is what it looks like, then what I want to still consider is, what does this threshold look on this curve? This is a curve with this is the efficient frontier that I could get when there was no riskless asset. But the portfolios that I was considering here was still a combination of just the risky assets. Now I want to throw in a riskless asset, and I still want to think in this portfolio, how does this curve relate to? It's a straight line for sure. So let's look at three different situations. Let's look at a situation where RF, the risk-free rate, is less than A over C. So first let's consider this. RF is less than A over C. So what is the most efficient thing to do if you wanted zero risk? What should be this constant kappa B? If you're looking at sigma squared equal to 0, what should be alpha B? Forget about this. Don't give me alpha in terms of kappa and eta. That I can do too. But what I meant was, economically speaking, if I'm looking for a portfolio with zero risk, what is the best return I can get? Risk-free rate. So that straight line starts off here. This straight line, whatever it be, will start off there. Zero risk, RF is the return. Okay? Now it's a straight line. So can this be a straight line? Could this be the efficient straight line? No. Why not?
It has to be tangent.
Why does it have to be tangent?
Because we have two different kinds of investors, risk flowers and risk neutrals, so as to adjust their portfolios as if they want to keep the risk-free or the portfolio of the mutual funds.
Yeah, one thing is that, but there's a simpler way of doing it, right? Which is, you can use simply again the same argument. If you're in here, you would never want an alpha sigma that's sitting here. This is inefficient. Why would you want to be there? You would immediately start moving upwards. You will start dragging this line upwards because on this line you have the same risk and you're getting better returns. So this cannot be optimum. So no matter which straight line you draw from here, which goes into that set, it cannot be optimum because you'll start dragging that line up. Similarly, this line is also not optimum. Why? Because for this for this particular, where will it go? Yeah, you will start pulling it down without getting any payment. So ultimately what you'll end up getting is that this is what that straight line would look like. So when you have a riskless asset, the efficient frontier looks like that. Let's remove all of this junk. It's this line. In this particular case, the first case is when the risk-free rate is less than the return. Yes?
Why would that second line not be good?
Which one?
The one that you drew that.
Oh, this one, actually, what will happen is that's unachievable.
Right.
Okay. So this is, so now let's try to get an idea of what does this point mean? What are you doing in order to achieve that point? Some value of alpha and sigma squared. How is that point being created?
By using some risk or
You can draw a line between that and the
Yep, it's a linear combination of risk-free and which portfolio? Where?
if you draw a line from the alpha to the
It is this portfolio. Let's call this phi star for the moment, just so that point can be generated by investing a certain amount in this portfolio and a certain amount of the risk-free rate. It's the same argument that I used for drawing that, convexifying that curve over there. This is achievable by looking at just the risky assets, because this is what I've already computed. This is simply an asset which says put money into the risk-free rate. Any combination here can be generated by putting a certain amount in the risk-free and a certain amount at this asset. What about points here? What's happening over there? Borrowing money. So a portfolio here is being generated by shorting the risk-free rate, which is the same thing as borrowing money, and investing it into this portfolio. And how do I get that? Because this point has the formulation which looks like minus lambda RF, or lambda RF plus 1 minus lambda phi star, where lambda is less than 0. Shorting or borrowing money and putting it into that portfolio over there.
So you can only borrow at a higher rate, and that line will just bend downwards.
Well, then all kinds of other things will happen. Then this whole nice theory of my x being unrestricted falls apart. Because then what happens is that when you're borrowing and lending at different rates, then I'll have to have two variables for how much I borrow and how much I lend. So I instead, or how much I buy or how much I sell. So you'll end up getting two variables here, and the constraint starts moving.
That would change the position of tangent portfolio.
Because then you'll end up, so this particular line is going to shift. You can't really have a straight line anymore. So you end up getting a convex set rather than a straight line. That's happening right now. Okay. All right. Okay. What else do I need to tell you about this? This particular portfolio, which is the tangent portfolio, has a name. Does anybody know what this name is? Well, market portfolio, but it's also somebody's name who decided to find this portfolio. Sharp. So this portfolio is called the Sharp optimum portfolio. Okay. Now, that's case number one. So in the case number one, what you have is that the risk-free rate is less than what the return at the minimum variance portfolio. Now let's try the other case. Case 2, when RF is greater than A over C. So now we have a picture. Let's erase all of this. So here is RF now. And we'll argue in a moment why this kind of situation cannot happen in the market, but so now what does the efficient frontier look like? My RF is above A over C, but I still know it's a straight line. What will I do? How will I construct that efficient portfolio frontier in this case. Last time around I was lucky because if I drew a straight line from RF above, I could get a tangent. This time, no matter what I do, I can't get a tangent from RF going up. So I'll have to get a tangent from RF going down. Okay? So that's same argument of tangency, we'll get it down. But will I ever hold that? No. I'll put everything in RF. So this is not efficient. Right?
Why can't you get a tangent going up?
It will cross into the curve. You can argue yourself that the moment you try to put a tangent from something going, because this is the point where the parabola is at its minimum.
Right.
If something's above and you try to construct a tangent, it just goes into the curve. And I know that that cannot be efficient. The moment I get into the curve, I cannot be efficient. So I've got to be on the boundary of the curve. So if I go into the boundary of the curve, then the only line is down here. But I'll never hold these because I might just hold RF. So this is not efficient. So what does the line, which efficiency line, look like in this case? What's happening in this market? In this market, would you even want to go into the market? No. If you were only going to hold long positions in this market, you would never want to go into the market because the minimum variance it's able to give you is here with a return which is less than RF. So the only reason you want to go into the market is because you're shorting everything. You're just, what?
It's something like,
It's not arbitrage. You can't make infinite amount of money. All you're doing is shorting the market and putting it into the bank. The bank rate is so much better than the market. S&P 500 is tanking, short it and put it into the bank. Right? So if that is happening, then what is the efficient frontier here? Question? Comment? How would it look like? It can't be a point because if I short more, I get more. I get more return, but I get more risk. Rather I short or I go long, my risk still remains the same. In this particular example, because everything is linear, my risk is the same whether I short or long. So I'm going to move into the risky side, but how would that line look like?
Point at RF and then point on the curve horizontal going along the curve up.
Here?
Well, if you go across horizontally straight.
Yeah. But the problem is if I do that, I'll go into the curve, and that's not efficient.
Up to the efficient point, you will have a...
There is no efficient point. That's the problem. So unless you were saying I go horizontal, right?
If horizontal and then follow the curve up.
But the curve looks like that. It's a straight line. It cannot follow the curve. I know by my result of looking at the most efficient portfolio that it must be a straight line. So it cannot be going up. You can't change the curve.
Why is it not a point?
It could be a point, but you have to argue to me that it's a point. It's certainly a point possible, but point will not be possible if I allow only x greater than or equal to 0, then you're absolutely right, it will be a point. If x is unrestricted, then it's not a point. You can short things. So suppose I'm on this line and I short things instead of holding it long, what will happen? What will it do to this line? Some of you are making hand gestures, you might as well just say it. What will it do? It's the mirror image along this line. So that is the efficient frontier. It flips over from the bottom to the top. Okay. Can this particular situation, so let's remove this situation here. I'm going to put this green line up there saying that's efficient, but the bottom I leave it there just so that we know what is happening. So that's the efficient frontier in that case. Can this situation happen in a long term over the market? No. Why not?
You can't have a negative risk premium. Can't have a negative risk premium.
Can't have a negative risk premium. Why? What will happen? What physical thing breaks down?
No one would invest in the risky asset and no one invests in
Exactly. So everybody is going to short it. Nobody wants to hold long positions. There is negative supply, which is the same thing as saying negative risk premium. if this situation happens in the market, if everybody believes this to be true, everybody wants to short the risky asset and put the money in the bank, everybody is on one side of the trading desk, there is no way you can sustain this in the market. You need to have people on both sides to be able to sustain a trade. And what this is saying is that if everybody believes that RF is greater than A over C, then everybody wants to short the asset, and therefore you would never have this sustaining for a very long time. So this is an unusual situation. This situation is okay. That situation has a positive and negative supply available, so this is okay. This is unsustainable. Now let's look at the third case where RF is equal to A over C. What happens in this case? When you start just at the corner there, what will happen? So now my RF is exactly equal to this. Again, I know that the efficient frontier looks like a straight line. So what will I do? So in this particular case, what happens is that you hold a net zero position. This is again not very interesting. What happens is that you hold a net zero position in the risky assets and invest in the risk-free asset. That's it. So in this particular case, you hold long and short positions. Here you hold only short positions. Here you hold a position. So 1 transpose phi is in fact equal to 0. So the positions in risky assets cancel each other. You don't invest anything really in the risky assets. The net wealth invested in risky assets is equal to 0, and $1 is invested in the risk-free asset. But the problem here is because there are no margin restrictions, you can hold arbitrarily positive and negative positions in the risky assets, you can get a curve. But if everybody does this, then you've got a problem. Why? Because by market clearing, the total supply of risky assets in the market must be 0. And there are companies issuing stocks. So where is that stock going to go? Somebody has to hold that stock. So again, this is not sustainable. So really in the market, what is sustainable is this. So one thing that it already says, this whole story, so far, one thing that you should keep in mind that in today's class we are doing two things. We are looking at a quadratic program. This is just an optimization problem. It doesn't have any meaning attached to it. It has got some positive definite matrix, some vector over here. You can solve it, you get an answer. All these three cases are equally interesting from the point of view of the optimization problem. It doesn't care about these three cases. It just knows that these are the optimal solutions. Now what we are doing is, on top of it, we are adding this discussion saying, if everybody in the market believes this is true, then it has certain implications for the market. Those implications are not coming from the optimization. They are coming from adding some extra economic information. And that information tells me that if the market is sustainable, then the risk-free interest rate must be less than A over C. This is a conclusion that comes from the optimization plus equilibrium. Either of these things separately by itself don't give me that information. The equilibrium part tells me that the bottom two conditions are not sustainable. The optimization part tells me that the optimum portfolio frontier looks like a parabola. You mix these two and you end up getting that the risk-free rate should be less than A over C. So it gives me some, from the point of view of, it tells me that there is something that I can check to whether this model is right or wrong. The model tells me that that should hold. You can try to check it and see if it's true or not. checking to see whether such things are true are still going on. People don't completely believe whether these models are true, but it's another thing that can come out of there. Okay? The thing that I will put into the notes again is the whole derivation of this, so that you can go back and reread it. For now, I wanted you to just see how it can be derived by looking at some geometrical pictures. What time do I have? Ah, good. Very good. All right, so the last topic that I want to talk about is how does this whole story relate to regression, and how does from there you end up getting some more predictable qualities about the market. So far all we have detected is this, that in a sustainable market that must be true, and that's just coming from the efficient frontier theory. Okay, so next story we want to do is what happens to the random returns on portfolios. So let's think of a portfolio, and here we will denote the portfolio by the weights on the risky assets. So therefore 1 transpose phi is actually less than or equal to 1. This is the convention that we used in doing the optimization for the case where you had a riskless asset. So that's the convention I'm going to continue following. Now what I'm going to say is that let R tilde phi denote the random return of portfolio phi. Whatever it is, I don't know what it is, but this is the random variable. This is not the expected value, but the entire random variable. And with R bar phi, I'm going to define the expected value of R tilde phi. Yes.
That the risky assets adds up not equal to 1.
Not equal to 1.
But you didn't say it has to be less than 1.
I didn't say it has to be less than 1. Who said?
Why is this less than or equal to holds here?
Oh, it's the same convention I'm using before. I've been using this convention that the total portfolio is going to sum to 1.
Right.
If I'm looking at, right now I'm just looking at the part of that portfolio that belongs to the risky assets.
Right.
But there is a riskless asset.
Right.
So when you take the slack of that equation is carried over by the riskless asset.
But we can short the riskless asset as well.
Yes, you can. But there is nothing here saying that which one?
If we short the riskless asset.
Yeah.
Right, right.
Okay. Let's for the moment assume that riskless cannot be shorted, but it's not going to make any difference. It's a good point. I need to make it not equal to 1 rather than less than or equal to 1. Anything that I'm saying here actually doesn't use the fact that phi is less than 1. The only thing it does use, it doesn't have to equal 1. Let's put it that way. Okay. So one thing that I'm going to try to do is now I'm looking at 2 different portfolios. Let's remove this. We don't need this picture right now. So now I'm considering 2 different portfolios, a portfolio phi and a portfolio psi. And what I want to do is regress the returns of the portfolio psi onto the risk-free rate and the return of the portfolio phi. I'm just doing linear regression. So this is a R tilde phi is a random quantity, that's the return. It's a random return on the portfolio psi. R tilde phi is the random return on the portfolio phi. And I also have this another portfolio which always invests everything into the risk-free rate. Okay? I can do linear regression, and the linear regression would tell me that this can be written as some beta 2 plus beta 1 plus an epsilon, such that the expected value of conditional expectation of epsilon given R tilde phi is equal to 0. This is simply, all I'm saying is do linear regression, you end up getting that condition. Now what I want to do is, what I want to see is, if I add another condition that this portfolio phi is in fact an efficient portfolio, it's a frontier portfolio, what extra information do I get about this regression? So this regression is true no matter what the 2 portfolios are. Just take any 2 portfolios, their expected values are, their returns are random, I can regress one over the other. Only thing I'm assuming here, they are jointly distributed. If they're not jointly distributed, beta 2 becomes 0. Fine. Now what I want to argue is if this portfolio happens to be also a frontier portfolio, it gives me more information. And what it tells me is the following. You can look through that computation over there, it's not a big deal. But basically what it says is that beta 1 and beta 2 are not independent. They have a relationship where beta 1 plus beta 2 adds up to beta. And what is beta? So you define something called the covariance. This pen don't work. So if you define the beta of phi, or actually psi, with respect to phi to be the following. It's the covariance of the return of psi and phi divided by the variance of the return on phi. So these are all random return. This is by definition the beta of a particular portfolio with respect to another portfolio. Then if the portfolio phi is efficient, then you can write that the return r tilde psi has the structure of beta times r tilde phi plus 1 minus beta times rf plus an epsilon. Okay? Question?
Is that expected value equals to 0?
That's like way out of my scope for this course. This is definition of linear regression. And yeah, this error term is conditionally independent of the predictors. So if what you should do is look up any simple book on linear regression, it will tell you why this is true. It's just a definition. Okay. All right. So far, all I'm doing is that if I take up the additional, if I assume that I'm only regressing on portfolios which are going to be efficient, then I know that a single number beta tells me what happens to the return of any portfolio. So the way to think about this expression is the following thing. I've got an efficient portfolio phi. Did you have a question? If you start with an efficient portfolio phi, then, and you want to describe what happens to the return of any other portfolio, then the only number that you have to compute is this beta. You tell me what the beta is, it describes completely what happens to this return. You take an expected value of this, you get even stronger because then this epsilon goes away. The expected value is exactly equal to r tilde phi, the expected value of r tilde phi, plus 1 minus beta times rf. And now the epsilon is gone too. If you apply this result to a given asset, so if a particular asset, a particular risky asset is itself a portfolio, it's a portfolio that invests all its money into one asset. This expression says here that the expected return on that asset, mu I, must equal beta times the expected value of the return on that particular efficient portfolio plus 1 minus beta times the risk-free rate. And I should put a beta I here, meaning it's the beta of that asset. So if you compute the beta of that asset with respect to any efficient portfolio, you immediately get that expression. And that expression says that the expected return on that asset I must have this relationship. It's beta times the return on the efficient portfolio plus 1 minus beta times the return on the risk-free rate. Okay? All right. Now the final punchline of this Markowitz story is the following. So all of this story, so this is one of the conclusions that I get from Markowitz plus equilibrium. This story is simply saying that if I add efficiency to linear regression, I get some interesting properties. I say that the return can be written as a linear combination of any efficient portfolio and the risk-free rate. And it's a convex combination between the return on the efficient portfolio and the risk-free rate. Now I'm going to add one more economic component called the market portfolio and claim that the market portfolio in fact is efficient. So instead of using some random portfolio there, I'm going to use the market portfolio and reinterpret what that means in terms of the market portfolio. That again will give me something else that is testable to believe this theory or disprove it. Okay. So here's what is happening in defining the market portfolio. We're going to assume that there are capital I investors in the market. And let's say that all of them start with an initial wealth W0 super I. And they take this initial wealth, which is assumed to be positive, so they have positive endowment here, and they put a certain fraction, which is W super I sub J, into asset J. This could be positive or negative. You could buy it or sell it. So the total wealth in the economy is simply the addition of the initial wealth of all the investors in the market. Let's call that W0 super M. The fraction of this total wealth that goes into asset J, let's call that WMJ. Just by market clearing condition, which says that basically every time you buy something, there is somebody willing to sell it to you, which means that not everybody is sitting on the sell side and not everybody is sitting on the buy side. There is trade going on. Then the quantity here represents the total investment into the Jth asset. This is the total wealth in the market. This is the fraction of the wealth that went into the asset J. That must equal the total money that was spent by each of the investors. You're just counting two different ways. One way you're counting the total wealth and then looking at the fraction. The other way you're just talking about how much fraction went into the market. This will not hold if the market is not in equilibrium. This will hold only if the market is in equilibrium. If you divide out, you get that fraction is given by that expression. You can compute this for every asset that's in the market, risk-free or riskless. You can just compute that thing. And let's call the portfolio that you get by taking these different weights, let's call that the market portfolio. This is the portfolio represented by the various holdings in the market. The claim is that this market portfolio is a frontier portfolio. So for the moment, let's assume that there are no riskless assets in the market. Let's make our life simpler. It's the same thing when the risky assets and riskless asset is present. But if you start with the assumption that the market does not have any riskless asset, then let's try to argue to ourselves that this market portfolio must be efficient. How would we prove this? Using the information, what do we have? What we have so far is, let's assume that the market does not have a riskless asset, which means all frontier portfolios look like that. It's a linear combination of some vector G and some vector H, depending upon alpha. Right? So using that fact, can we somehow show that the market portfolio must be efficient? So what's happening is that everybody, all the investors in the market, are trying to solve the Markowitz problem. The only difference between these investors is the return that they want. Different investors might want different returns depending upon their risk-return profile. Somebody doesn't want any risk at all or the minimum possible risk, so he's going to sit at the minimum variance portfolio. Somebody is willing to take on more risk, so he'll go and buy a return which is higher. So all of them, all the investors are holding portfolios that look like this. Now, from that, and they are going to invest positive wealth into the market. We are just assuming that this guy invests positive wealth into the market. Then what would the market portfolio look like in this particular case? What it will look like would be the following. So let's say that investor I wants a return alpha I, whatever it may be. So therefore investor I holds phi of alpha I. And therefore the market portfolio W of M is basically summation of I going from 1 to capital I of the initial wealth of the ith investor times phi alpha I divided by the sum of all the wealths over all investors. That's what the market portfolio is.
Here there's no riskless asset.
What?
There's no riskless asset here.
Yeah.
But to your wealth, you can invest it in a riskless asset.
No. I'm just saying that in the market there is no riskless asset. There is nothing there.
Oh, okay.
The market doesn't have one. The same argument will hold for the other case. Here it's just written on the board. It's very simple. The expression, the fact that I'll be using would only simply be that W is positive. That's all. So now if you put in the expression for phi of alpha I from here, you end up getting that this summation is Wi0 G plus alpha I H divided by the sum of Wi0. I just put in the expression for what phi of alpha I looks like. Separate out the various things, you end up getting this is equal to G, this and that cancel out when you multiply by G, plus summation of Wi0 alpha I divided by sum of Wi0 something H. So this is effectively the return on the market, alpha M. Since I have shown to you that the market portfolio looks like a combination of this kind, it's G plus some alpha times H. This expression implies that the market is efficient. So the market is an efficient portfolio, which means that in this expression, instead of this R phi of alpha, which is some efficient portfolio, I can plug in the market portfolio and get this expression, which says that if you look at the return on any asset, subtract from it the risk-free rate. In this particular expression, I didn't show you with the risk-free rate. Let's just take the risk-free rate to be 0. There's nothing you're getting out of there. Then the effective return is equal to, the expected return is equal to the beta of the asset on the market times the return on the market. So one number, beta, one sufficient statistic, beta Jm, completely describes what happens to the expected return if you know what the market returns are. Okay, so we have, in the previous slide, we have a result which says no matter which efficient portfolio I pick, this expression holds, and therefore this expression holds. In the next slide, what we have worked towards is basically saying that if I look at the market portfolio, and what is the market portfolio doing? The market portfolio is simply saying, look at the total amount invested in a particular asset divided by the total wealth in the economy. That's the market portfolio. That portfolio is easy to define. I don't have to go looking at various investors. I don't have to find out what an efficient portfolio is and so on. I can just look at the total investment in the market divided by the total value in the market. That gives me a portfolio. You can argue that there are people who would argue, well, that's not possible. What about real estate? That's something you can invest in it. What does it mean to be the total fraction and so on? So there's debate on whether you can even define the market portfolio. But let's say you can define the market portfolio in some reasonable fashion, then that market portfolio is an efficient portfolio. Therefore, I can use that expression that I had before by plugging in the market return times the beta of the asset with respect to the market portfolio. And I get this straight line, which says the following. That here's the straight line, here's the return, let's call it alpha m, and for any value of beta, this is what the straight line looks like. This is mu j is equal to rf plus beta times alpha m minus rf. So if you tell me what beta is, so here's, I shouldn't put alpha m here. I'm plotting beta here, and on this axis I'm plotting, so this line at the point beta equal to 0, I get RF. So this point here is RF. If beta is equal to 0, I get RF, otherwise I get a line. And what this basic economic content of this line is the following. If beta is known, then the expected return is completely defined. I don't have to know anything else. And what it also says is that if beta is positive, this, or let's say beta is greater than, how do I want to say this? Let's talk about one more thing. So this quantity mu j minus RF is called the excess return. Which is the return in excess of the risk-free rate. You can always get RF by putting money into the risk-free rate. So mu j minus RF tells you the excess return. So this expression can also be written as mu j minus RF is equal to beta times alpha m minus RF, which is to say that the excess return on a particular asset is equal to beta times the excess return on the market portfolio. So if beta is positive, it implies that the excess return yeah, I want to go, but the problem is, yeah, let's make it less. If beta is greater than 1, it implies the excess return is large. And if beta is less than 1, it means that the excess return is small. All of this is compared to market. Right. All right, so we are running out of time. On Thursday, I'll talk about a little bit more about the economics behind all of this, so that you get a little bit more better picture of what's happening here.
Next one.